Thank you for being with us tonight as we explore how MIFID II is and will continue to impact your business. Thank you to the panelists for joining us this evening. I'm both honored and excited to be here with all of you at this wonderful event to moderate this panel as we talk with such talented and well-respected individuals in our industry. So on our panel, we have Wallace Mathai-Davis, Evan Fire, Stephen Glass, and Mitch Pinote. And we'd like to get started and kick off the panel this evening with Wallace, as he'd like to discuss 7 main points on the business implications of MIFID II.
Thank you, and thank you for being here. Can you hear me? Am I close enough? I'm going to review what, to me, are highlight 7 basic business issues. I think my colleagues on the panel are going to be able to address those issues quite specifically and, in fact, have some deep domain expertise that I do not want to claim, although as somebody who's been running firms on the buy side for a number of years, on a practical level, I've had to deal with the consequences of the great advice that I would receive from domain experts. But let me just very quickly do this. There's 7 items. Number 1, liquidity. I know no one who believes that MIFID is going to change liquidity profiles. Liquidity is primarily a function of the financial instruments. Some instruments have more liquidity, some have less. Sometimes the trading desk is going to be long some or short some. That really determines the pricing within a range that you get when you buy and sell from them. No one expects liquidity to be impacted. Second point, concentration of trading. This is going to be a major effect, and it reinforces a trend that already exists in a very pronounced way, namely that trading will be concentrated in fewer and fewer firms. I've spoken to a number of global heads of trading of very large firms, plus 100 billion under management firms. They typically are going to have 100 to 125 counterparties with which they deal. They're moving it down to 70 with MIFID, and within 3 to 4 years, the people that I have spoken to are talking about 30 to 40 firms. Think about it. In a 36-month period, reducing the number of trading counterparties by more than half. I think that you would find that, and we were talking earlier in the speaker's room, that even firms that would have 35 trading counterparties will be reducing those trading counterparties by 50%. What does this mean? And I would, Mary, and thank you, Mary, that was a quite concise but really wonderful overview of MIFID. I don't think it levels any playing field. MIFID is tilting this playing field and tilting it in very specific ways. The bottom line is the big fish are going to eat the small fish. It will favor large versus small in very specific ways. This does not level any playing field. The smaller brokers are going to struggle. Their business is going to be taken by the larger. And that's something we could discuss in some greater detail. Let's talk about the price of research. Right now, on the fixed income side, there's a lot of price transparency in terms of what the research is going to cost, and firms have publicly discussed that. On the equity side, price discovery for research is at the moment still extremely opaque. MIFID will allow tiered pricing, and once again, it tilts this playing field. Firms that are doing billions of dollars of trades in a year, and a firm with 150 billion under management is going to be doing billions. They will get a different pricing. Pricing is going to be platform-based. So you're pricing for Asia ex-Japan equities. That trading desk will have a pricing schedule different than a trading desk that's doing, for example, small mid-caps in the United States. So pricing will be platform-based. There will be a tiered pricing. That tiered pricing must be applied to all clients. The tier cannot be changed, but it can be established. Smaller firms who do less volume will pay more. The next point is the geographic reach, and that's very interesting, and I think Mary made a great point. This is 1.4 million paragraphs. It's actually 70,000 pages. It is absolutely not clear how the regulations themselves will be defined. In some areas it's clear, some areas it's not. The European regulators, at least in my experience, and I'm chairman of a subsidiary of the Deutsche Börse here and was on the supervisory board of that's how I ended up being the chairman. Our company was sold to the Deutsche Börse, but the regulations that, for example, govern our company, which is an FX ECN, have not yet been finished under either the MTF or the CEF regime. It will be a few years before the specific regulations are defined. So when we talk about geographic reach, that I think is going to be worked out in the detail. What determines MIFID? I have been told that it is advisor location, and I have been told that it's client location. And it's not defined. There are general intentions, but the regulation has to be itself in detail defined. Best execution. What is best execution? And Mitch will discuss that in some detail. He's quite a domain expert on that. But what is best execution? It appears that it is going to price. Now, for those of you who trade instruments that may be more away from the middle, like Latin American securities, anything in frontier markets, any of the smaller markets in various types of currencies, price is not what you consider alone when deciding who your counterparty is. You may get a good price on the way in, but somebody who will not make you a market on the way out, or if you do it, that spread is very wide. But what MIFID appears to be doing is it seems that it's going to end up price. And this can occur in mainline securities. High yield has become much more used today, but you still have the issue. Do I want to do a deal with the best price, or do I want to do a deal with a broker where A, I know he makes me a good market when I'm selling, and secondly, I'm his first call. So do I take Latin American corporate bonds? You want to pay an eighth more to be sure you have a market when you sell? Do you want to pay an eighth more so you're first call and you're serving your client better? Those nuances in best execution have not yet been defined, but it appears that it's moving towards price. Quality of the research. Now, I would say MIFID has just raised the PE of CFAs in this room who are analysts. Because what's going to happen is the firms are going to bring people in, and they're also going to use outsourced resources such as CEIC, FactSet, S&P Clarify, for example. Those firms are going to be able to have a stronger market for the research than they have today, because it will substitute for the research that is coming from any of the large broker-dealers. How is that quality going to be maintained? And once again, the playing field here is not level. You have 150 billion under management, and you're averaging a 50 basis point average investment management fee. You have even 40, 50 billion. You have plenty of money to pay for it. It doesn't even pinch. The CEOs don't like to see any additional cost. It's not going to fundamentally change the franchise. You have $1 billion and it begins to pinch. You're a 500 million global large cap manager, which can do very well with 500 million. You're going to see some increased cost. And in order to solve it, you're going to concentrate your trades with even fewer brokers to be able to get to the right tiered pricing. So this entire issue of quality of research is going to be very significant. And the last point, the seventh one, is trading itself. The concept of transparency is not necessarily the best for effective trading and best execution. Let's take a block trade. You don't want to advertise your block trade. You want to do your block trade as quietly as possible. Dark pools are very effective vehicles when you start looking at block trades. Now, according to the MIFID rule, and there's some exceptions, again, Mitch will mention them, but there's a limit. Only 8% of daily volume can be done in a dark pool. So if I'm moving, and I can talk about a trade that I know very specifically about, if I'm moving a 400 million block trade, I want to do that in the dark pool. I don't want to do it over an open trading desk. I want a dark pool. These efficiencies on the trading side are not necessarily efficiencies that lead to better execution. I want to circle back on the issue of geographic reach, because the geographic reach leads to regulatory arbitrage and does not take into account the regulator's first obligation is not to create a better global investment environment. The regulator's obligation is to be sure that in the national sovereignty, that sovereignty has a strong, stable, competitive financial sector. And you don't do that by making trading easier for the Americans if you're Europeans. You do that for your own companies. The Chinese are a great example of this. Many years ago, when the IPO market in China was heating up and IPOs were being done in Hong Kong and the United States, the Chinese put in a regulation that if it is more than $1 billion in market cap IPO, it has to be done in China. The Americans strongly objected to that, and the Chinese said very simply, we're building a financial market. Our companies have to list here because this is China. We're not going to make your market better. So likewise, when you look at the push, you have to take into account the regulator's obligations. Singapore, for example, is becoming the center for trading in Asia ex-Japan. The Singaporeans are going to look at how do they create something that works for Singapore in the long range. So these issues all become very significant ones. So there's 7 issues that I see that will be dispositive in the workout that we have in MIFID. And the one point that I would say is there's no level playing field here at all. Just the opposite. And I think we can go into some details later, but I defer to my colleagues now to dig into that.
Great. Thanks, Wallace. I saw a lot of nodding of heads, so I think those 7 points that you've just discussed at a high level can resonate with the folks in the room and probably on the line as well. So thanks for that. So we'd like to speak with Evan a bit as you come from the buy-side perspective, as you work with Pzena Asset Management as the COO and CIO. So we'd like to hear from your perspective as a U.S. manager with both EU or UK clients. What would you say are the most meaningful impacts of MIFID II to your business?
Sure. So a little perspective. Pzena Investment Management has been around for about 23 years now. We manage just under $40 billion. We're a deep value equity manager and have strategies that span the globe. Our client base is very diverse. We have a large U.S. base of clients, but we also have European and UK clients, Australian clients, some Asian clients. So we see it all in terms of client expectation. And what I would say is my colleague and I, who have been working on this MIFID problem for the last 2 years, I'd say. In my house, MIFID is a dirty word, so we don't say it very often. The reality is we've been planning for not necessarily the obligation to be MIFID compliant, but the client expectation. And we had a lot of MIFID denial at the executive level for a while. People didn't want to believe it was going to affect us. turns out we were right, and it is affecting us. And the reality is we sit in a strange place because as an SEC-regulated entity, we don't have much wiggle room to be a MIFID compliant entity. There are some carve-outs, obviously, that the SEC gave us, and there are no action letters, but you can't get all the way there. For example, forming an RPA, challenging, right? Because you start putting client money in a bank account that an investment manager manages, you might cross into custody rules. So we were in a weird spot that we were trying to figure out what to do. And what we've done is we've tried to create a transparent operation. We took what I think the premise of MIFID was supposed to be about transparency, especially when it comes to soft dollars and costs. And we built, or are building, through technology. Actually, ComSice is a vendor that we chose to put in place to basically virtually unbundle all of our trades, to create a more transparent view of research, what we're using client commission dollars for. The challenging part there is, and Wallace, you touched on a number of the points that are important, price discovery. Not many sell-side brokers want to tell you what a piece of research costs. There are 2 brokers I know of that have given you a Chinese menu that actually outline those costs. Most of the other brokers are continuing to be very opaque about what those costs are. And so we've had to make some assumptions about what our rate cards look like for the things that we're consuming. But what's really challenging about the impact of MIFID for us is that that wasn't good enough for some clients. And the expectation, based on that survey, I actually think 53% is a little low. I think the reality is, in Europe especially, the gauntlet has been thrown down that if you want to compete, you need to pay for research yourself. And if you want to compete as a U.S. asset manager against European asset managers for EU assets, you better have a competitive pricing model. And that doesn't mean charging them for research. And so I do think that we are all heading towards, and this is Evan Fire speaking as me, the person, not Pzena Investment Management, but I do think we're all heading towards a P&L world. The writing seems to be on the wall, but we'll see. And in the meantime, there's a lot of dust settling.
Okay, thanks for that. So what type of impact is it having on non-EU or UK asset owners and their expectations of managers regarding research?
Yeah, so that's a good question. I sit in an interesting spot being in charge of technology and operations. The reality is we see a number, we've seen hundreds now of requests in the form of due diligence questions from U.S. asset owners asking about the implications of MIFID II. Some just want to know what you're doing. Others want to know what you're doing so that they can prove that you're not treating them unfairly. And so, you know, you have to be very careful about the conversation of running a U.S. and EU business model, because if you start to favor your EU clients and give them an execution-only solution because they won't accept soft dollars anymore, how far can you push that before your U.S. clients start to say, well, that's not fair. I don't want to foot that bill. How is that going to, you know, be sustainable long term? The reality is I don't think it is. And so that's a growing pressure that we're seeing, that U.S. managers are wanting more transparency, and they're wanting to know what you're doing about MIFID. And some of the really large institutions have already pushed people into no more soft dollars. So I think that is going to continue, but once again, we'll see.
And just generally, you know, we've heard a lot about the unintended consequences of MIFID II, and this, you know, has been talked about a solution in search of a problem. You know, generally, what do you think are the long-term implications, more so than just, you know, going away with soft dollars and the P&L route of MIFID II for the industry?
So I think there are a couple of things. One, the consolidation of broker relationships, that's very real. We are in the neighborhood of 40 or so trading relationships. That'll probably shrink. We get research from a number of providers. That list will probably shrink. I don't know the tune to which it will shrink yet, but it probably isn't far from 50% if I took a guess. We'll see if any of our sell-side brokers are in here. I'm sorry to tell you that. The other implication is, first of all, enormous resource drain for the last 2 years. I'd say me and about 5 other colleagues have been on a working group internally for the last year of that 2-year stretch, and we've spent, I personally have spent probably 60 to 70% of my bandwidth on MIFID-related issues, trying to solve the complexity of what we can do to meet all these expectations. So that's obviously a terrible waste of resources on something that doesn't add value to your business. And so between that, and I won't go into it deeply, but GDPR, which I also hate, it's not fun what's coming out of Europe right now. And I think the reality that a lot of smaller firms are going to disappear because they can't survive without soft dollars, that probably is a very real unintended consequence. So my recommendation is, in the meantime, you should probably be finding a way to get smarter about your consumption. We've done so in a way of virtually unbundling using ComSice, and that's actually been a really good way of bridging the gap between now and whatever we're all heading for. So that's been a great solution for us.
Okay, thanks. Thanks for the perspective of the buy side. Appreciate that. So Stephen, wanted to talk to you as a CEO of your consulting firm, and specifically with respect to MiFID II's commission and research on bundling rules. As a consultant to asset owners, so from that perspective, do you feel those rules are a good thing? And conversely, are there risks that asset owners need to think and worry about?
Yeah, thank you, Melissa. For those of you who don't know, Zeno, what we used to be called Plexus, we are sort of a boutique TCA firm. For tax reasons, back in 2010, we changed our name to Zeno, still doing the same stuff. Our clients, as Melissa said, they're asset owners. And, we started to take an interest in MiFID II going all the way back years to sort of the miners report back in the UK. And it became sort of apparent to me that most of the conversation going on was about the impact that MiFID II would have on the buy side, perhaps the sell side and research providers, but there was very little discussion for plan sponsors, mutual funds, the end clients. And so I'm coming at this from a very different direction. Although a lot of what's already been said, I think I would 100% agree, 50% agree with. In fact, some of your questionnaires might have been from some of our clients.
Thanks.
But, yeah, in terms of, from an asset owner's perspective, I'll say this, I like the spirit and the intent of MiFID II. I think transparency into research spending, accountability about research spending and the need to justify it, those are good things. Has the rules, have the FCA and ESMA over-engineered this in some way? Probably yes. But, at the end of the day, I still view it as a best practice. And to the extent that from a geographic perspective, it migrates here along the lines of what Evan was saying, where people need to start thinking about this. That's what we're advising our clients, that they have a right to expect their asset managers to adhere to some best practices and a little more transparency, a little bit more accountability into how the asset managers are spending their money, which may or may not end up being the case if Evan's vision is correct. That's a good thing. In terms of whether or not this creates risks for asset owners, for our clients, we think it does. where we think that there's a number of issues. First and foremost, I think the issue that the regulators were concerned about was, are your commissions for my global or developed markets product being used to subsidize the research costs of the manager's emerging markets product? Right? Are we, in essence, cross-subsidizing other people? So hopefully that we move away from that, because MiFID II requires sort of product or fund-specific budgets. So that's actually less of a concern, of an ongoing concern for me. What's more of a concern is a point that I think we've already heard about, and I kind of agree with Evan. I'm not sure what Mary is, but I actually think that 53% is a bit low from what we're seeing. We just got through, on behalf of our clients, talking to, in a collegial way, about 40 odd buy-side firms regarding their research budget. About of the 40 managers who were running non-US or global products for our clients. And about 70% of them indicated that they intended to pay for that research out of their P&L for at least some of their clients. Okay? Now, what went further was 30% of those also acknowledged that they were going to pay for their European clients' research costs, but not their US clients, not our clients. And to Evan's point, let me just echo this, that's going to go over like a lead balloon. Whether it's simply an asset manager, and there's been some who've submitted letters to the SEC saying as a fiduciary that was an uncomfortable situation for them, or to the extent a client has a most favored nations clause in their contract. I served for 10 years in the 80s and early 90s as general counsel to a public fund. That would not have gone over well to find out that an asset manager was covering their European clients' costs, but was still using my fund assets to buy research and maybe subsidizing some of those costs. The other really big risk, which, well, it's a risk in two, and then I'll shut up, is of the managers who indicated that they were paying out of their own P&L for research, 40% refused to tell us how much they were spending. So there goes your transparency. Right? They felt it was proprietary because they were using their own money, which I understand, but at the same time, for my clients, for the plan sponsors, that creates an investment risk. Because all of a sudden now, before, and I think Wallace mentioned this, before MiFID II, it's the investment team at the buy-side shop who decides what research you need, right? Whether it's the analysts or the traders, maybe the portfolio managers, maybe a CIO occasionally, right? And maybe they overspent because they were using their clients' money a little. But now that you're bringing it in-house, you've now brought probably the second largest expense item right behind personnel costs, I'd imagine, onto your books. So now the CIO is grappling with the CFO over profit margin and shareholder value. And anecdotally, at least what I'm hearing is that the CFOs tend to be winning. So, when we talk, when Mary showed statistics about how many funds were planning on reducing their research spend, yeah, we're hearing something on the order of cutting it by 50% or something of that order. And my question for my clients is that enough research to sustain the historical performance that you've hired that firm for? Right. So, yeah, I think there are risks. That's, again, coming from the end client's perspective. But
If I can, before Mitch speaks, I make a very brief comment. One of the dimensions that has been left out entirely in this discussion is the end game, namely performing well for your client. And there's going to be a dynamic here, and it's going to be quite simple. To the degree that you are creating alpha, to the degree that you consistently are moving above a benchmark, your clients are going to leave you alone.
Yeah.
To the degree that you don't, you become a commodity asset manager that is under the current pressure that I think you're all aware of of the transformation of the buy side with the quantitative revolution as a result of big data, increased computing power, and the ability to apply technology. There's real issues about how much value do these managers bring in the first place. And today, they're under pressure from movements in quantitative analytics that are the result of technology. I would make the case that there are very few long cash market managers that our firm cannot reproduce everything they do using some AI-driven factor analytics and do it for a fraction.
I
And
don't
that's what you
agree.
see happen. I'm sorry?
I don't agree.
I know. That's the great debate. That is the great debate. At the end of the day, the tasting is what is going to drive it. Are the performance there? But there's many managers that are just not strong enough to resist. And there are others. If you take Baupost, do you really think that Seth Klarman is going to answer these questions? Do you think he's really going to say, no, I'm going to do what you want and I'm going to pay for research? If I quote an extreme, I can't give you his name. There was a conference of plan sponsors, so all the CIOs were there. They were really hitting fees. This guy is outperformed in some very significant way. And he said to the assembled group, you want my performance, pay my fees. But you have to deliver to be able to do that. So it's a dynamic that we're not putting it into the debate. It's going to be part of this play out of what are these regulations going to look like when they're actually there. For the company that I chair, for example, we spend €1 million a year on complying with CEF regulations for a regulatory regime brought in 4 years ago, and the regulations are still not defined.
So Wallace, I agree with one part of your statement, which
Not the
is
quantitative
not
part.
the quantitative part, but we have actually debated this internally because we do believe that our research approach and our fundamental way of building portfolios will outperform benchmarks over the long term. And because of that alpha generation, we actually see a lot of this as an opportunity because, there's been this huge move to passive and everyone's worried active management's not going to be around. The reality is active management is not going to be around for two reasons. One, you suck at your job and you can't get the returns. And two, MIFID II is going to gobble some firms up. So if you can survive those two things and produce long-term, you actually have an opportunity. And that's the way we look at it internally.
I would agree with that perspective. How it plays it out is going to be interesting. But I think Mitch has got some really interesting things to say about this as well. Sorry.
And just
I know
before-
when they're going to end it, and so we have to maybe get a little bit going here.
Just one more question for Stephen before we go over to Mitch on the Best X side. And I'm personally curious, have you seen instances where managers say that they need to continue buying research with soft dollars for their U.S. clients, even though they're able to use their own hard dollars for their European clients? And what are you counseling your clients in these examples?
Yes, and so yes, we've had a number of asset managers write in and say because of some of the regulations here regarding can investment banks, sell research for hard dollars without being a registered investment advisor, right? Technically, now if you're truly a MIFID manager, you have this window for 30 months. But for U.S. asset managers, you can make the argument that exemption doesn't apply to them. So a number of our clients have been told by some of their managers who are paying for P&L for the European clients, but sort of saying that we can't do that yet for you, so we're still going to use soft dollars. I'll be honest, I find that a bit disingenuous. And the reason for that is as follows. By virtue of paying execution-only rates for your European clients, the asset manager knows what that X-only rate is. And it's simple math to figure out, okay, if I have to pay for research in the U.S. for my U.S. accounts with soft dollars, fine. But I know, how much of that 12 basis point, commission, how much of that was for research, because I know what the X-only rate was by virtue of my European accounts. So it's, simple enough for an asset manager to say, all right, I have to pay the higher commission rate, but I'll either give you a rebate, or give you a credit on your asset management, your quarterly asset management fee. There's ways to do it. I don't know if they actually did it, but I know at one point there were reports in the press. MFS basically said that they would take that approach. And to be quite honest, while I'm not a huge fan of commission recapture, for the asset owners here, you sort of know what that is. But, for a manager who insisted on charging their U.S. clients soft dollars and with no transparency, I guess if they could justify it, but took a really hard-line position, the asset owner does have the means to say, well, okay, but we need you to send all of our trades to some discount broker at a penny a share, or give us a rebate or something like that. So, I'm not comfortable yet with a manager saying, I'll pay, for my European clients. And one last point, just to piggyback before Mitch
Thanks, Steve.
brings us over the goal line, right? I'm not quite sure, and I get a sense from both the first two, that there's this irresistible trend where managers have to start spending their own money to buy research. Maybe call me a contrarian, and maybe it's because I deal with plan sponsors all the time. I don't think that they would react nearly as negatively as I think most of the buy side has felt towards the idea of an asset manager coming to them and saying, I need $50,000 for research, but guess what? You're only going to pay X-only rates and commissions. It's probably less than what you were paying last year. We've actually had 3 or 4 clients who were approached by their managers with these RPA accounts. 100% have been approved. And some of those letters, I think, were not compliant with MIFID 2, but our clients were still comfortable with that. At some point, what's implicit in what we've all been saying is that asset managers have a business risk if they're not going to get enough research. If you can't afford it to take it onto your books, how are you going to get it? It's either an asset management fee increase or with your client's money. Either way, you got to justify it to your clients. And I think most plan sponsors are a little bit more open to that than maybe the buy side's giving them credit for. Just food for thought.
Okay.
Thanks, Steve. Hi, Melissa.
Hi, I don't
How
think
are
we
you?
need much of an introduction about what you're going to speak about, right?
I would love to address a couple of points that Wallace
Sure.
brought up. So as far as best execution, just to take a step back, I've been building best execution trading platforms for 18 years, and best execution means something different for every type of manager, right? So Garnet Funds Group is in the business of building execution policies, and it's based on quantitative and qualitative factors, right? So when you mention best execution has to do with price, Wallace, price is fine, but market impact is probably the most important, right? What's going to happen to that order if it leaks, if it's noisy, right? You want to be quiet. You mentioned 8% caps for dark pools. For large and scale orders, they're exempt, right? So you can trade as many blocks as you'd like, and that's fantastic for the market. Other execution factors that go into best execution, costs, market impact, which Plexus here can definitely comment on. The timing and speed of the execution, likelihood of execution, the size of the order, the liquidity at the venue that you're going to. And so all those factors, play into a buy-side firm's best execution policy, which, Melissa, if you want to go ahead and get into the questions, I'm ready to dive right in.
Okay, we got a meaty
Did you want to comment, Wallace?
I would only ask you, is it trending to price? The people that I've spoken to in Europe fear that at the end of the day, measuring those other characteristics in a quantitative way that is consistent is going to be challenging, and their concern is, at the end of the day, it will be driven by price metric.
All right, so there's a very valuable metric out there called fill rate. How often do you go to a venue and actually get filled? And if you keep going to a venue over and over again, you're not getting anything done, or you're getting maybe a small execution, 100 shares, it's probably not the best likelihood of an execution. So what the full transparency, and you mentioned transparency, and it's not, blocks are never transparent before they go up. Of course, they hit the tape and then they're on the tape. But, you know, when it comes to, and I'm losing my train of thought here, Evan, but I think you know what I'm talking about. When it comes to putting up a large block at the midpoint, that is not revealed before it goes up on the tape, right?
You're dealing with a trading desk. The trader does not have a fiduciary obligation to a non-client. So if he's able, and that's what good traders are supposed to do, they're supposed to find out what's going into the market. And how many times have you been in the morning and you hear, we've got a big buyer out of Asia for this name. We've got a big seller out of Asia. He's not breaching any fiduciary obligation because that trader received it through the way traders get information by being active in the market. When you're in a dark pool, that doesn't happen.
So if you are executing electronically, you're doing it yourself. You're not going to a broker's desk.
Correct.
You're not going to a
But
voice
when you
broker.
work large orders, you have different ways to work them. This is why black pools became so useful. You might want to comment.
Yeah, so I mean, I think one thing, because we sit in between this world and our traders are always trying to figure out how to maximize an order in terms of execution quality, but we're also a value manager and we are very limit conscious. So our traders, I never say this in front of them, but our traders aren't there to create the alpha. Like they're order entry, and they would kill me for saying that. But the reality is our PMs are setting price limits, and those price limits, if you're going to use price as a best execution kind of parameter, that's not really going to prove our trading strategy from a best X standpoint. So I agree with what was said. The reality is market impact. You know, how you execute that order, how you approach the venues, and how you introduce that trade into the market, whether it be through an algo or through a dark pool, where you're going slow, you're doing a volume, toggle, whatever it might be. The reality is how much you move the needle is really what you should be judged on. And I think that'll still play a role. I don't know.
I don't either.
Yeah.
I don't think we're going to know. I don't think we're going to know for a couple of years. I can tell you in our firm here, not Quantalytics, but the firm where I'm chairman, we're spending €1 million a year and don't know how it's going to play out. We're just convinced that it's like a glacier moving and ultimately they're going to get there, and therefore we will be rewarded, but we don't know how it's playing out. And I think MIFID is going to be like that. Remember, MIFID is actually three things. It's MIFID, MIFR, and then the technical standards, which is controlled by ESMA. So you've got three massive regulatory regimes, and it has to be melded. So how it plays out. And the other part is good firms led by people like my colleagues here, they know how to structure. So I don't know what the response will be. I will say what's underestimated is interests are not the same. I think the Europeans are putting a burden on their firms, none of which are really strong. If you want to look at the strong sell-side firms, they're not in Europe. You got one bank in Europe, BNP. That's the only bank that really has a good balance sheet. The rest of them are struggling, have capital requirements. The capital that they're going to be able to allocate to their trading desks is limited. They do win because the larger firms are going to eat the smaller firms, so their trading is going to get better. You go to Asia, which is now rising, there's a regulatory tension. I know in the United States we have been unable, at least in the sectors where I'm involved, to reach an accommodation with the European regulators. So you have an MTF, multilateral trading platform in Europe, and you have a CEF here, different roles. The CEF is being developed, and up to now, it has been done in a way where American firms are not going to be disadvantaged. And they're not going to concede some of the regulations that the Europeans apply to our MTF in Europe, for example. So how that all works out is going to be an interesting, it's going to be an interesting process with conflict.
So Mitch,
It's
next.
going to be great engagements for these guys. Keep your kids in private school, they're fine.
So April 30th, so just next week, buy-side firms trading in the EU will have to publicly publish, for the first time ever, RTS 28 best execution reports. What transparency do you think these reports are going to bring?
It's a great question because this is Monday, everybody. You're going to be able to see every buy-side European firm publish their top 5 brokers by percent of volume, as well as the top 5 venues that they're using. And then from there, you can do some qualitative and quantitative research that goes into your best execution policy, right? Which basically all those factors I was mentioning, fill rates and size. So this full transparency, I think the SEC is looking at pretty strongly. And my bet is that in the next couple months, they're not going to kick the can down the road as they did with the unbundling, which is just enormous compared to establishing a best execution policy, which firms should be able to do. I'm sure Pzina's on their way. So I think it's going to be great for the industry, great for the investors. It's all about investor protection. Stephen Major said there's 10 trillion euros on the sidelines in bank accounts. So obviously investors in Europe don't feel that there are no conflicts. So I think he wants to take those 10 trillion euros and have them getting more than a 1.5% return.
Okay. And what impact do you think these reports will have on non-EU trading, U.S. asset managers and their best execution responsibilities?
So it's, they're going to be a disadvantage. The U.S. firms that aren't, I mean, Pzina's on its way. You guys are showing leadership, right? I mean, you guys are ahead of the game. So if you're not going to publish a best execution policy while your counterpart in Europe's doing it, it's going to hurt. Investors are going to see that. So investors are going to be able to quantify and see qualitative data and in Europe, but not see it in the United States. That's not a level playing field. So I think U.S. managers need to get it together.
Okay.
The challenge with that is if in the U.S. you're still trading bundled and in the European markets you're fully unbundled, you're going to end up with some challenges on the data comparison because you're going to have squishy numbers in the U.S. and you're going to have pure numbers in the EU. So it's going to take a little while for that price discovery and the data analysis to actually sync up.
Right.
And it's been mentioned a couple times by Mary and on the panel that in the fourth quarter of last year, specifically November, the SEC had issued 3 no-action letters related to MIFID II's research provisions. It's intended to pause unbundling for the 30-month period while a review is conducted. However, the best execution as it relates to the RTS 28 was noticeably not mentioned in that. So do you expect that the SEC is going to move more quickly on the best execution?
Which,
front?
yeah, I actually kind of got ahead of that, and I was actually explaining that since 2012, ESMA and the SEC have had what they call a supervisory cooperation arrangement, and I do think that the folks at the SEC are going to move very quickly and make best execution policy a mandate.
Okay. Okay. Any other comments from our panelists before we open up the floor to questions from our audience? Okay. Okay, great. At this time, we'll take questions from the audience. We have a microphone just in the back of the room.
Hi, yeah, Bill Siegel. Very interesting, stimulating, thought-provoking conversation. My question is, what can, assuming worst-case scenario, from your point of view, 30 months down the line, we go European and MIFID is a reality here. What changes would you like to see in the research industry to help you survive and prosper?
Sounds like I probably am the one to answer that. So I think the biggest challenge in trying to sort this all out is that when you're communicating with your most important research providers, the reality is there's not a lot of open disclosure on the value of what you're actually receiving. You know, in the technology world, when I want to buy a new application or get some new data, although data providers, don't get me started there, you know, you talk about a price, there's a list price, and then you negotiate, and you get to a number, and you say, yeah, that works. And with the research, it's not that way. And if we're all heading to a place where we have to pay for it out of our pocket, we got to get to a price. And, you know, I think what that'll do is the best research providers and the best analysts are going to clean up, because if they are that good, they're going to be able to charge a premium because their service and their quality will be higher. I think the lower end providers are going to disappear because they're just not going to be worth the money. So, you know, I think helping with that discovery, that's the first thing that would really help. Because even if you want to virtually unbundle, and, you know, to your point about maybe rebating or something like that, the reality is you have to use something to unbundle that commission. And you have to know, you know, what that split is, execution and soft commission. And then you have to attribute your consumption somehow of, I took 5 analyst meetings, I have 4 models that I read, I had a corporate access meeting with the CEO, and that all tallies up to $10,000. Okay, well, I spent $10,000 with Morgan Stanley. Now I know what I spent. We all agree on that. I'll pay your bill. I can rebate that cost in a world where we don't get to a MIFID regime, where we still have to trade bundled. If you know those costs, you can at least get to a fair playing field and be able to unbundle it virtually, show from an accounting perspective that client A, B, C spent $10,000 and rebate that $10,000 back to them and still be able to pay through the old regime. So that discovery is, I think, is really what's important.
Could I add one quick point just from one, agree 100%. Everybody do what Evan said, okay? But in addition, one thing that I haven't seen, and I wonder maybe if anybody here has some thoughts as well, you know, the regulators also contemplated that asset managers would be able to calculate an ROI, a return on investment, of their research spend. So that, and I have yet to see any asset manager, and we've now close to 200 reviews that we've done of different portfolios. Nobody yet has even attempted to try and say, here's our return on investment for the $6 million we just spent in research. I know, you know, so somewhere along the line, it would be great if and maybe it gets to some of the thinking that Evan was just sort of implying should happen, to be able to say, well, what was this really worth it? Did we consume it? And did we get any value out of that? But if we ever get to that place, that will be an important development.
Yeah, so for us, we thought about that as we started this journey, and quantifying an ROI on a squishy thing is near impossible. Yeah. And so what you had to do first was systematically dissect the process. You had to peel apart the data, hence why we use ComScience, because what it does is it says fundamentally, I understand that I, as an analyst, consumed 15 things throughout the month. Those 15 things I've rated as being worth X, Y, or Z. I then can uptick them because of the extreme value, or I can downtick them because they really weren't worth the money that we said. Now you start to quantify the difference between what a base value is and what a really good thing is. And if you can then analyze through some sort of business intelligence the ROI off of that extra value,
Right.
now you might be able to prove
Almost
that.
talking about looking at your alpha.
Yeah.
So, right?
Yep.
Great. Additional question here in the third row. Thanks.
Hi. This is on the fixed income side. In a bundled world, the bid-offer spread would partly include sell-side research costs. In an unbundled world, do you have any view that if you're paying separately for research, what's the effect going to be on fixed income bid-offer spreads?
Can I answer that?
You definitely
Spent a lot of
should.
time.
I'm an equity guy, so.
It has always
Equity guy.
been said that if soft dollars would go away, you'd see that spread narrow. You've never seen the spread narrow.
Do you think it's going to narrow?
There's an expectation, yeah. At least in Europe, they think that that spread is going to narrow, but it's always qualified. We've never seen it narrow. So you have fixed income managers that do not take soft dollars. There's no evidence that their spread is narrower. But spreads are so tight on fixed income to begin with. At a certain point when, except for the specialty fixed incomes, no less, when that spread narrows, that ROI for that trader is potentially very, trading company and the capital that must be allocated to do it. That gets very, very narrow. They may not have that flexibility, particularly as the competition becomes so much stronger. And on the analyst side, I don't think it's that simple. You know, when you start saying, where do you buy research today? So look at vended research to the buy side that doesn't come from sell-side firms. It's largely macro, and then very specific sectors. So you can find providers on the energy sector. If you want to look, for example, at e-commerce in China, where there's been just dramatic returns over the last couple of years, you could take Tencent as the measure of that. What firm is providing sell-side type research on e-commerce in China and selling it? For one thing, buy side will not pay what it's worth. You don't see $125,000, $200,000 engagements for that type. You will for some other type of research that's oriented towards hedge funds. So that is going to change the world. The best thing for the analysts, for example, that are at the sell side, is they should get together, create their own firm, go to the clients that they've been serving and say, now we'll give you this research. And I think you're going to see some of that happen. But at the moment, where do you find firms that are providing equity research similar to what you get from the sell side that are independent and can survive? Because they're not going to survive on a $25,000 engagement. BCA, I don't know if many of you deal with them. There's a long and distinguished history with this firm. If you get their fully loaded service, it's $50,000 a year. I'm on the board, was on the board of a foundation in Europe. We got their research. $50,000 a year. We could talk to their strategists. The average fee is $25,000. Try to run a serious business where your unit cost is $50,000. 10 clients give you $500,000. Where do you go? 20 will make you $1 million. You can't run it on $1 million. So can you really have a viable business? All of this, as I said, I think is up for grabs. There is no simple solution in independent research houses for specific types of research beyond the macro. And by the way, good macro research, when you're buying it, they tend not to be seat-based. It's $50,000 a year. That's what you pay for guys that are good at it. Hard to run a business that way. Thank
Very
you.
great. Thank you so much for your participation.
All right, before we start,
Maura.
I see the bar and the food being set up, so I'll be real quick. First and foremost, thank you to the panel. I thought you did a fantastic job. You really framed it well with the 7 main core issues of MIFID 3. I think, as Steve said, the intent of the rule with better transparency and accountability around costs is a good thing. But yeah, I think it may have been over-engineered, and maybe looking forward to MIFID 3. But that said, a couple of administrative things before we wrap up. I want to say thank you to the CFA Society, and especially the Business Management Interest Group. A lot of work was done tonight by Mike Lee and Tim Frazier over there. Make sure you say thank you. They really, really put a lot of sweat into tonight. The other thing I just do want to say is that there are a couple more events coming up in May. May 3rd, we have the annual Green Bonds event. May 16th, it should be an interesting evening where the BMIG group is co-sponsoring an event with the Young Leaders Group, how to build and launch a new business. And I think there's a really interesting group of panelists who have started their own businesses and are going to be speaking to the CFA Society. And also keep in mind the CFA Society is not a members-only society. We do have, our events are open to non-members. So share with your colleagues and your friends about the topics we present to the group. They're very often as interesting as this, and I find a lot of value out of them. And I'm going to end it there.